Hey everyone, welcome back. Happy Tuesday. It is 11 o'clock Pacific Standard Time. I'm out on the west coast of Canada, so I've been enjoying the summer, doing a bunch of paddleboarding, spending time in the pool, swimming in the lake just a little bit, but I hope you guys are enjoying the summer. I mean, this is obviously a flat time of year to be trading, and it's kind of nice to be able to be in a position where I can make money when the market doesn't move up or down. Now, I don't like to waste time on this channel, so I'm going to jump right in. If you guys have specific questions about what stocks you want me to cover, please type them in the chat. Let me know. Otherwise, I'm just going to go into this and I'll just kind of freewheel because this is a live chat, and I've obviously put in a ton of trades already today. And I'm just going to pop open IBKR here. You guys can see that. And if anybody could let me know that it all sounds good and looks good, but otherwise I'm just going to continue on, that would be fantastic. I'm a one-man show, so this is I always have to just kind of go by your feedback. So appreciate that. And also let me know where you guys are calling in from. So let's take a look. Here's the heat map for today. Why does this look? This looks a little bit wrong. Let me refresh this. There we go. That looks a little better, doesn't it? Oh, okay, so a bunch of green on today's screen. Pretty much everything across the board is up. Everything, tech, communications, Amazon, everything looking really good. So if we take a look over at the monitor, obviously the Qs are up, and Qs are trading at 297, up 3% today, which is great for my portfolio. I am holding some long Q delta right now, not a massive amount, just a tiny bit. So this up move is great. I'm expecting that Qs are going to rally up to around the 310 mark, and that's kind of where I'm targeting for the next little while over the summer. SPY trading up today 2.6%. Pretty neutral positions for me in SPY in general. The VIX coming down today, so not a fantastic day to be entering new spreads or credit options, but still an elevated VIX at 24% expected move over the next year. So looking at this, if I was today, with it being so green, this is days where I like to sell calls. Kevin's calling in from Lakeland, Florida. Thanks so much. And Vinny's asking about any thoughts on Snap earnings play. Ludicrous IV at 250. Really? Snap's IVR at 250? Let's look. I do have a Snap play on already that's slightly bearish. And wow, 79 IVR. So yeah, very elevated Snap earnings are going to be coming up. So how do we know when earnings are coming up? You can subscribe to data if you're with IBKR, or some brokers actually show when earnings are, but otherwise you can just go over to TradingView. I like to use TradingView because it marks on here when earnings are. So we've got earnings the 21st of July, and obviously today is the 19th, so in 2 days. I don't know whether or not that is before or after the market close, but let's take a look at Snap in general. Let's take a quick look over at Seeking Alpha. I love to use Seeking Alpha. Someone is asking me about how I choose stocks. I mean, Seeking Alpha is a great little resource. It's pretty inexpensive. You can sign up for an annual package, and I actually have a discount code down below. So if you guys are watching, you can get 50% off if you sign up using my code, which is pretty awesome for you. And they give me a little kickback, just so you know, for that. But I do use the service myself. And Snap, here we go. We've got a warning from Seeking Alpha at a high risk of performing badly, strong sell. The biggest problem here with Snap is it's not profitable. It's got poor momentum, and its valuation is still too high. So looking at the forward P/E, 68 times how much it earns, and this is because it's not profitable. It's not currently making any money, so it's really hard to have a stock price that is higher or has a decently low a price to earnings ratio, because it's not earning any money, or it's not earning enough. So let's take a look at Snap and see. Let's take a look at that chart actually. Let's look at Snap here. So you can see the range that it's been trading in has been getting tighter and tighter. And so the Bollinger Bands are very tight. And looking at an upper Bollinger of only 1540 and the lower Bollinger of only 1270. And it's right at the midpoint. So when I'm looking at an earnings trade, typically what I'm doing is I'm looking at the expected move, and it's pretty easy to see what that's going to be. We just look at the options expiring this week, and we look at the at the money options. So you can see the value of the call, the at the money. The stock's trading at $14, and so the at the money option is 14 strike. So I take the value of the call, which is $1.40 approximately, and I take the value of the put and I add those together. So we've got a total value, if I was to buy both of those, of around $2.68. It would cost me to own the long straddle in this case. And the expected move is usually about 80% of this, 80 to 90%. So you can use that kind of as a back of the envelope calculation to say how far do we expect Snap to move over earnings in this time frame. Now so 268 or $2, and we'll say like $2.20. So the expectation is that the stock could go down to as low as 1180, 1190, about that, or up as high as 1650. So that's kind of the typical way to kind of figure out how much it might move. Now, when the IVR is really high, and where we can make money on this is if it doesn't move that far. Let's say that expected move is, let's go back to trading view here, and I'll just draw some on the screen a little bit. So we said 1620 was the expected move to the top side, 1630 approximately. So $2.20 move, and that would be the upper range right there. And then the lower range would be around 1180 or 90. So that's kind of the expected move, is that the stock is going to trade kind of inside of here. Now, where we can make money is if it does stay inside of that. There's a couple different ways you can do it. You could either bet that it's going to move out of that and try to make money on a directional play, usually one way or the other, or we can try to make some money if it stays in play. Now, my profit target personally on this is around $12. I think that this earnings report is not going to be great. It's going to lose some shareholder value, and we're going to see a drop on earnings. So I actually have a bearish trade in play right now that will make more money if the stock goes up and has limited risk if the stock goes down. Now, if you're interested in seeing exactly the trade that I have on, you can join my Discord. You head over to Patreon and become a patron, and then you can access my Discord chat, which I'm on daily, and I make a ton of trades. Look at that graphic right over my face. Isn't that fantastic? So there we go. Patreon, if you're interested in becoming a patron, great time to sign up. Anytime is a good time to sign up, because I include for all my patrons, they get a copy of my rolling options calculator, which is like $50 on my website. It's $50 to become a patron for a month. So basically the first month is free, and because that rolling options calculator is an absolutely fantastic spreadsheet. And if you're having a hard time tracking your trades, then check that out, because that's what I use every day. All right, so now let us take a look at the actual platform and set up a trade. Now, if I was doing a earnings trade, I typically like to go out a little bit further than the time frame that is earnings. So if earnings is this week, I wouldn't sell for this Friday. I would look at the July 29th contract, so a week past. And if the expected move is around that 1160 mark or 1190 mark, what I want to do is I want to sell a put outside of that range. And then likewise, I want to sell a put on the opposite side. Now, it looks like the pricing is such that we're getting a little bit more premium for the upside, which means there's upside risk. So to make this neutral, I can't see how there's upside risk on this, but okay, not a profit. Maybe people are expecting that there's going to be profits this quarter. I just can't imagine in this particular market. But nonetheless, that's what the option pricing is telling us. So if we look at the how big a risk we want to take, we can pick our short strikes. We're neutral. This is a 19 delta. This is a 23 delta. I could go down to the 18, but as I said, I'm bearish overall on Snap. Seeking Alpha is also bearish. I'm not going to take a bullish position. I would rather have a slight negative delta on this play. So that's what I'm looking at. And I've somehow got that long straddle in there. So here we go. That's the kind of the base move. Now I could collect 90 cents for this. That's just a straight up strangle. Is this a good idea on Snap? I don't like to trade plays like this on stocks like this because on the downside, not so bad. Worst case scenario, I'm buying stock at $10.60 when it's currently trading at $14.40. So the break even is extremely low. The stock would have to drop almost $4 before I'm losing money on this trade, well outside the expected move. But on the top side, I don't love to take that kind of risk. So what I can do is I can limit it just in case something happens and they are extremely profitable and the stock doubles, which it could in this case. I mean, if you look back at where Snap was before, Snap was trading at $50 not that long ago. So in this event, I mean, something could happen and there could be a massive, massive move. Now, if I look at that, you're just losing money infinitely to the upside. So in this particular case, I wouldn't want to trade, but I may consider putting on some risk. I might say, well, I'm willing to lose. I'm risking $1,000 to the downside. Maybe I'm willing to buy some protection. The premium here, only a couple cents per strike. So I would probably go pretty tight. Let's just see if I can put one of these in. So this is basically a lizard. That's what we're looking at. The chart isn't quite full here, but the solid line should be coming down. The dotted line is if the stock moved today, how much money that it would be worth. Probability of profit, I'm looking at any of these trades that I'm entering new trades on for at least a 67%. And this one does that with a 68% probability of profit. Very limited risk. If the stock does go up, I'd only lose $179. And the potential in this trade is actually $75, which is extremely, extremely high. We have that break even of 10.79, and then the stock would have to trade between 10.79 and 18.21 for the next 10 days. So that's the trade. And why don't I just put this on and we'll just see. Now I have to do it to the ask because this is a demo brokerage account with IBKR, but I would normally try to go for the mid price. So I'm just going to submit this order and we get paid if we look at what is happening. So I'm selling the July 29th 111 put, which is a contract that says that I am willing to pay $11.50 per for 100 shares. So $1,150 or $11.50 each times 100 shares. Then I'm also agreeing to sell some Snap shares on or before July 29th for $17.50 call. And in which case, if the stock goes above that, this would cost me money. And if it stays below, then the stock or this option expires worthless on July 29th. I'm also buying a July 29th 20 call. And what that is that's giving me the right to call shares away from somebody else for $20. And this is what limits that upside risk. So if you're looking at why this profit profile looks like this and why there's this limited loss to the upside, it's because say the stock went to $40, somebody could call the shares away from me for $17.50 and I would have to buy them because I don't own them in my account. I would have to buy them for $40 at market value and I would be out $2,200. But since I own this long call, I would be able to either call the shares away from somebody else instead of buying them on the open market, and I would be able to call them away for $20 and then sell them at sell them at $17.50 and I would be out $250. The risk is limited because of the credit collected. So in this case, $73 and then the $250 difference. And that's why the risk is limited to that 179 or whatever it is. It's if I plug this into my chart, you would be able to see that. So, Summer Unicorn, okay. Summer's asking about a unicorn trade. Well, we'll get to that, Summer. And let me just transmit this and get this filled. And then it will appear in our portfolio. What else do we have on? We did a little... We've got those forward calls. I'm not selling anything against those right now. I'm not really monitoring this portfolio. It's super not exciting for me to show you this on a regular basis because I typically am just randomly putting on trades in this and not actually managing it actively. IMAX, you can see the market value 17.59. We obviously traded that quite well. Etsy, I'm short 100 shares in this account and Did I do a long call? No, I should just clear some of this up one of these days and actually track this portfolio for you guys. But we've got filled on this one 71 cents, and this is a lizard. So we've got a short put, a short call, and a long 20 call. All right. So Summer's asking about Unicorn. And she's asking about January 20th, 2023 and on July 19th, 2022. Which of these dates to put in line D17 expiration of the journal? Oh boy, I'm gonna have to turn off my Discord, otherwise you're gonna hear a whole bunch of annoying beeps. I'm gonna close that for you. Obviously, somebody over on the Reddit Wall Street Bets they like tag everyone, and it's kind of hilarious, but not really. There's just a constant like barrage of people when it starts. So that doesn't happen on my Discord server, thankfully. We're pretty chill over there. We're just talking about option trading in general, and it's a great place to ask questions. So if Summer's question is, Unicorn has two dates of expiration, January 2023 and July 29th, 2022. Which of these dates to put in line D17 expiration of the journal? So in my journal, let me just pull up a Unicorn trade so you guys can take a look at how I enter a Unicorn and kind of how they function. Let me look at my Visa Unicorn. That's probably one of the better ones to show you. And because Visa is on an up move right now. Where is mine? Just give me 1 second here. I'll just pull it up. Is it Visa? Okay, so here's my Visa Unicorn, and I'll show you how this functions. Just give me one moment here. What Summer's asking about is in my rolling options record keeper, which is available on my website. Basically, the way that this functions is a Unicorn trade creates cash over time because it has short calls that are expiring usually on a weekly basis, sometimes on a bi-weekly, but you could do it monthly if you wanted as well. And the idea is that I'm holding long calls against this. So I get to sell two short calls. And in this case, you can see on May 27th, I was holding two 205s that were set to expire May 27th. Sorry, this original trade was October 28th. We've been in this for a while. Extremely lucrative type of trade. This one will literally be more than 100% return this year, which is amazing on a stock that has barely moved. If we look back at all of the transactions. So in this case, what Summer's asking is which date to put on. So in all of the positions are right here, and the Unicorn has two expiration dates. So when on July 15th, which was the last time that I adjusted this trade, what I'm doing is I'm putting in the record of what I'm currently holding. So it doesn't matter whether or not I bought those on the day or bought them before. In this case, you can see these January 2023. I don't adjust this portion of the trade, which is why you need a rolling record keeper that, I can't find the right button here. Sorry about that. So this position I haven't adjusted what is happening each time. So on June 17th, what I did was I sold into these 197 calls and I collected $1.86. Then on June 24th, the June 24th contracts had expired or were about to expire, and I rolled them out to 200. I actually paid a small debit to roll up from the 197s to the 200 because the stock was at 203. And then I was holding the July 1st 200 short calls. Then on July 1st, these were about to expire. Stock was trading at 196. I just rolled them out. I basically bought to close these two, sold to open these two, collected $310. And you can see how Unicorn works. It's like, it just pays me every week, $186. This one cost me $94 to roll up. Then the next week I got paid $310, paid $245, got paid $476. So these are extremely lucrative trades if the stock doesn't move around a ton. And you can see the stock trades within a $20 range. Last month, June 17th, trading at 189. Now we are sitting here July 15th, it's trading at 209. And so the stock doesn't move a huge amount. These January 2023 calls are the later expiration, and they're not part of this $186 because they haven't adjusted. All that's happening is I'm just moving them over from one date to the next to say that, yes, I'm holding it, but there's no actual transactions on those dates. They're just getting less and less extrinsic value as the time goes by. And the 140 is in the money, so it holds its intrinsic value. So when you're entering a unicorn into the record keeper, the near term expiration is always in row 17, and then the later expiration is in row 24. It's usually only for long calls. I do have a custom spreadsheet in here, and that's what I would use to jump over to the, where's my, this one right here. This is the sheet that I would use if I was doing something really complex. I would just make a copy, and in this case, anything that is, so I would just say duplicate, and I could start a new trade, and I could do any sort of expiration I want. I can just put in, let me show you guys how I fill this in. So say we're doing this today. We're going to do this on Visa, and we're going to say July 19th, and I can just give it whatever name I want, as long as the first, before the first space is Visa, it will, or V, the ticker symbol for Visa, it will pull up the price here. And it also shows that it's US dollars. So this is current price, 213.70. And I can just type in whatever I want here. In this case, I can say a unicorn. And if I was doing that, my first expiration date would be, so I have to type in the price at 213.70, and then it's going to highlight, option expiration date would be July 29th. And then I would have my short calls. In that case, I would say, 205, and I have 2 contracts of those. And then if I wanted my later expiration date, anything that appears below just kind of gets recorded as a later expiration. This kind of just in order. So these long calls, I could have multiples here. So I would have a later expiration of 1/20/23. And then if the number is appearing funny, you just go up to the formats and just format it as a date. And then the long call, I have the 140 and then the 220. So that's how I would set this up. And either of these can be used. Sometimes I like to use this for, we're gonna say like $65, because that's about how much it would cost to enter now, I think. And quantity of the above trade. And basically what this trade does is it creates a profit profile that is, oops. So I've got all these warnings in here to make sure you guys enter things correctly, myself included. But basically what it does is it shows us a profit hump to one side. Now, one of the problems with unicorns in this is that this is the estimated profit or loss chart at expiration, but it does not include fees or potential remaining value of options with later expiration dates. And I know that this can sometimes be confusing. This is a record keeper. It is not pulling real-time option data. I can rely on my brokerage to pull that data, and it's why the chart kind of doesn't have that extrinsic value for the later date. So on these unicorns, what I'm doing is when it's set up, I'm just making sure the profit peak is where I think the stock is going to trade. So in this case, the height of the peak is at 205. Stock is trading at 213. This would be a slightly bearish trade, making more money if the stock went down. But it also is a bullish trade in general, because it's all calls, and I do only 2 long calls with longer dates. The idea is that I'm selling short calls for weekly income against it. I love this trade. It's a great trade when stocks are at a good valuation to buy. So if I was looking at Visa and looking at whether or not this would be a good buy today, first thing I would do is check Seeking Alpha. You can see the quant rating on this is a hold. But one of the things I'm looking at is the stock prices run up a little bit, and this might not be a good time to be entering a trade in Visa, just looking at the moving averages. So if we go to Visa, you can see where the stock is. It's been trending up and up and up. And this is, why does this have 2 E's on it? That's interesting. So we have July 13th and July 26th. I'm not sure if that's when they announced the earnings, but this is I don't think Visa has announced its earnings yet. but that is the scheduled earnings. Didn't actually put, I am so lazy with my Visa trade. It is, I just expect that the stock is not going to trade outside of its range very often. So it's just kind of going up and down, and I roll those calls for weekly income. And this, it does have a slightly bullish skew to it. So the lower the stock goes, the greater that skew becomes. But Visa is a very well-known company. Obviously, they have tons of customers, and they have a very steady income stream. So I'm not expecting anything, brand new and exciting from Visa. I'm just expecting that this share is going to continue to hold its value over time, and that it's not going to trade extreme ranges left or right, or sorry, up or down. And my expectation is that I'm just going to continue to hold it with that long haul leap, and over time make money off of the cash flow that comes in. So that's kind of how the unicorn works. I know I talk about unicorns a lot. It's a form of poor man's covered call, and it's something that I invented, and I like it because there's 2 short calls that pay me weekly, so it's pretty nice. No other questions today. What is going on? We've got 20 people online. I'm sure you guys can come up with some questions. Please ask away. Otherwise, if you're new, then remember to hit that. Well, I'm looking for buttons right now. These are different ways. I always have to duck out of the way of this graphic. These are different ways that you can get access to me. If you decide you want to join Patreon, then you can come onto the Discord chat room, and you can chat with me directly. You get to see all my trades if you become a patron, which is pretty awesome. And that rolling options calculator that I was just showing you, the record keeper, that is a free download for patrons. So it's basically like, it's $50 on my website. If you guys go check that out, you can purchase it at Drawbridge Finance, or you can go over to Patreon, become a patron, and download it for free. So it's like getting a free month, which is pretty awesome. What else are we going to do? So hopefully there's some questions. Can you explain the Batman? I cannot see it on the list of strategies. Sure. Batman's kind of a loose term. I use the Batman for a multitude of different trades, but basically what it is it's a look at, it looks like Batman ears. If we look at the profile of it here, let me pull up a trade, and we will take a look at what a Batman looks like. So I'll do it in the brokerage, and then you'll understand. So the simplest form of a Batman is just to do a call ratio spread and a call ratio spread and a let me do. I'm just trying to think of what I'm going to pull this up on Netflix. So we could do a call ratio spread to the upside and a put ratio spread to the downside. And not all brokerages let you do this very easily. I know some brokerages like Tasty Trade limit you to only 4 legs. So in that case, if I was doing something complex like a butterfly, a 3-2-1 butterfly for the downside, or a 3-2-1 butterfly call butterfly to the upside, then I would just enter that as 2 trades. So let's look at Netflix, because earnings is coming up, so there might be a potential in here. So we're going to look out a little bit further, July 29th. I'm going to scroll down so that we can kind of see the range. We can see the 1 standard deviation moves at 162.50, and the upper range is a 240. So that's kind of the 1 standard deviation move, which is quite similar to the Bollinger Bands. Now, if I was looking at this chart and I was thinking, okay, let me just pop over here, keep scrolling through here. I'm looking at Netflix. To be clear, I'm a little bit bearish on Netflix earnings. I think Netflix is just getting pummeled, and I think that this next earnings report, like the last earnings, look at how much their stock dropped. And now this one, I'm not expecting huge things from Netflix. So especially that it's top of the Bollinger, and it is today after the bell, but I do expect a down move in here. But I'm going to show you what a Batman trade looks like on Netflix. So if we went over here and we did very simply, we're going to sell a position that is going to make money if the stock goes down to 165. And then we were going to buy a position, we're going to sell a position that loses money if the stock goes down. Why is this not working? There we go. 165 will lose money if the stock goes down below 165. So this is a naked put, so to speak. We make this into a ratio spread by selling 2 and then buying 1. In this case, we're going to collect a net credit. So This is not very fun here. There we go. Now we can see the little spike. So what's happened is a ratio spread, very simply, selling 2 contracts, buying 1. So there's a naked put at 165 and there's a bear put debit spread that is part of this trade. That's why this little spike happens on this side. Now, since this is earnings and I'm worried about it, what I could do is I could do a butterfly. So I could buy a butterfly. Now this one would have to be entered for a net debit. I don't love it. We've got this little spike. So what I do is I set this up as a 3-2-1 butterfly. I buy 2 of the 160 puts and I sell 3 of the 165s. So you guys have probably seen me do this before and you can see how this adjustment works. But basically now what's happened is I have limited loss. I can't lose more than 485 bucks. My credit to enter is going to be much higher, around $60 to enter. And I have the potential, if the stock goes down to 165, to make up to $500. Because I'm collecting a credit of 50 bucks, this profit chart's quite wrong. And that's why I use my rolling options calculator, because it's basically using this 15 cents as the maximum profit, but this profit line would be the 50 cents if I was filled for 50 cents. So it would be slightly higher and not something that I love about IBKR, and it's one of the reasons I use my rolling options calculator. So that is the stock is trading at $200 right now. So the stock's trading right here and would make 50 bucks if the stock stays where it is for the next week and a half before July 29th. As long as it stays above 170, all of the puts will expire worthless and I'll just keep whatever credit I collected to open the trade today. So that is the left side of the Batman. So if your brokerage doesn't allow you to enter a Batman as a single trade, this would be the first portion of it, the put leg. IBKR does let us do it, so it's pretty great. All I have to do is go over here and I'm going to do the same sort of thing. So this is if we look at the setup, we've got a $5 wide spread, and then we've got another $5 wide spread. So one's bear, one's bull. And they're all just $5 apart. So we're going to do the exact same thing on the top side. We're going to I'll do it at the 230s, 235s, 240s. Actually, I'll do it at the 240. So we would buy the 235, we would sell 3 of the 240s, and then we buy 2 of the 245s. And we just change the contracts in here. So we go sell 3 of those and buy 2 of the 245s. And any variation of this will kind of create this Batman trade, but probability of profit on this trade is extremely high, 68% chance. The net credit to open is quite lucrative. This would be $120. So if the stock stayed between the 170 put and the 235 call, then all of the options would expire worthless and I would just keep the credit that I received today. So in this case, it'd be $123. The max risk on this trade obviously is the cost to buy out. Would cost up to $500 to buy out minus whatever credit I collected. So the max risk on this trade is around 380 bucks if I was to open it for $120. And that's why this profit profile is a little wrong, because this is showing 475 when it's really actually only about 380 if you filled for 120. But there's what this trade is it looks like a Batman, and that's the reason why. Now, I said I use a couple different variations and different terminology for a couple different trades. So this one is a 3-2-1 put butterfly and a 3-2-1 call butterfly to create this profile. If I didn't want to have the downside protection, I could also I could maybe not buy as many calls. I could add risk on this upside, and I could just do a 1-3-1, which is also another trade that I like to do. This I would also consider a Batman trade because it has these little ears to the side. So in this case, getting a substantially bigger credit. This one collects almost $800, uses a lot more margin, but if the stock stays in this range, I get a nice, $800 in premium because I'm taking this risk to the outside that the Netflix I would lose money if Netflix traded outside of this. And I may not want to do this. And I probably wouldn't trade in Netflix with a naked strategy like this, even though it seems so easy to just make $800 in a week. But there's a lot of risk to that trade. The other thing I could do is just take off the long protective calls altogether. I could just say, well, I'll take off these the lowest put and the upper call, and then I would just convert these into, I could do them as 3-1s, or I could just do regular spreads or ratio spreads, which are 2-1 setup usually. So you're selling 2 times the contracts compared to buying 1. And this is also a Batman trade, and so the Batman becomes just kind of a term for this type of setup where I have a profit peak to either side. And usually I'm trying to keep it pretty neutral. I'm not making these skewed to one side or the other, because the whole idea is, especially on something like earnings, the expectation is that it's going to stay within the range. But what I'm looking for is a little bit of a bump up if the stock moves over into this profit hump, because this is pretty good payoff. Like, this is a $650 credit and makes that $650 as long as the stock stays below 235 and above 170. So it's got quite a long range. And if it was to sneak down below 170 or even close to it, there's a chance to close this for an additional credit. So this trade could actually make an additional $500 on top of what I collected today. So if I got 650, so the total profit on this would be like $1,150 if it was right at the peak, which I don't expect. In this case, when I'm playing a Batman, what I hope is that the stock just runs down to, like, even if it ran down to 175 just before expiration, like on July 29th, if this trade was trading, 171, 175, I would be able to collect additional credit to close it. Likewise, if it ran close up to the 229. Where I don't like this trade is when the stock blows past it and we're trading over, past this 250 mark. It's pretty easy to defend because I can roll it out as a put or as a call and just convert it to a straddle or strangle. But it's less than ideal. Usually I want these peaks out near the outer Bollinger Bands. So that's kind of the setup for the Batman. Hopefully that makes sense. You guys may have to rewatch that. I just blasted through the Batman, but that is the idea. Les says, I'm new. Do you trade delta neutral a lot? I can't find much in that on YouTube. I trade quite a delta neutral portfolio. I wish I made more videos. It's super time consuming to make videos, but thank you, Les, for joining today. In general, I'm a delta neutral trader. Today I put on a ton of iron condors for August. So really what I'm trying to do is I'm trying to sell premium and collect Theta Decay. But I also do other strategies like dynamic hedging where I'm long volatility. So in the overall setup of my portfolio is delta neutral. Obviously in this bear market, I'm trying to keep a slightly negative peak to a lot of my trades, because if we do continue to grind lower, then I want to be able to make profits. And that Batman trade that we just went through is an example of where we could do a delta neutral trade, but we have the advantage of being able to make a little bit more money on either side. Typically I'm trading out a month and I'm closing, under that 3-week window. As soon as we're in that 21 days to entry, days to expiration, I'm trying to take off trades. And, the idea is that I get to collect Theta and be able to make money on a daily basis because of Theta Decay. Now, that said, I do a ton of trades that are quite specific for pricing. So trades like the unicorn, where I am very specifically targeting a price and getting into that, into this sort of thing. And I like to do complex strategies. And one of the reasons I do that is because, trades like Iron Condor weren't working in 2017. There's right now they're working in basically since the crash. Iron Condors have been a great trade. The VIX has been so high that it's no problem to do that. But if we look, let's just pull up the VIX here. I'll show you kind of what I'm talking about for those of you who are new, because people don't realize. Well, that's a silly screen. Let's just look at the VIX. So if we look at the VIX over time, what has happened since 2020 here is we have seen this elevated VIX level. So February of 2020, in this time frame right here, I had almost no trades on, and when this volatility exploded up, and you guys can go back and look at my Patreon and see exactly what trades I had on. But one of the reasons for that was because we had this kind of grinding lower volatility. And if you're looking at this, like, look at this level, 13, like we were trading down into 13. Now, historically, the average is right around 17, 18. And I was mentioning about the 2017 and how hard it was to trade. So if we go back in time, I started trading options in 2012. We had elevated VIX, but it wasn't crazy high. And I did pretty well, you know, like I learned to delta neutral trade. I learned how to sell puts. I learned how to sell covered calls, and this was a pretty basic strategy. And back then I was working a ton, so I was traveling all over the world. And I didn't have a huge amount of time to monitor it, and I didn't have a time to make complex trades. This worked pretty well, and I kind of ground through this, and I was making like a pretty decent, you know, 15 to 20% a year on my options trades. And then in 2016, we saw some more action, and we had some heightened volatility. And this was extremely lucrative, and it was quite good. 2017 came along, and during this time, I just assumed that I would be able to continue to play these same trades that had been working so well for now years. I had basically been trading, making close to 20% or just over 20% most years. All of a sudden in 2017, I was not making any money. I was just doing the same thing. I was trading iron condors, and this VIX, as it kind of drifted downward, was absolutely horrible. This entire year, I made nothing trading options. I mean, I made some, but it was such a minimal amount. It offset my time cost at all. And I was quite frustrated with that, because when you watch YouTubers, what you see is strategies that are continually being applied, like iron condors, and you're just like, oh, it's so easy. But the reality is I want to make money all the time, and when the VIX is low, it really, really sucks. 2018, we got to see a bit of a resurgence. And then obviously in 2020, we saw this massive spike up in the VIX. And this brought a lot of new traders into the market in general. This VIX spike corresponded with a V-shaped recovery in the SPY, or in the markets in general. And the markets were drifting up as the VIX was dropping over 2021. And this made for an extremely lucrative 2021. Now, this continued into the early 2021. And in March, I know there was quite a few people that got quite burned here in March of 2021 because of this little bit of an increase that happened. You know, we were churning along, and all of a sudden it jumped up. And people that were over leveraged found out very quickly that there is risk when the volatility snaps up, and it was because of a slight down move. Now, the tech sell-off started around here. So if anybody that was long tech, and I happen to have quite a bit of tech last year, was feeling the pain of two different things: volatility collapsing and the market going down and the stocks actually selling off. So it made it an extremely difficult time. The tech sell-off was selling off, but it was messy. There was just a lot more movement than there should have been relative to the amount of VIX that there was and the amount of premium. Now, so last year I started playing with unicorns, and during this downturn, when we saw this low period, I started to put them on, because one of the things that I wanted to do was I wanted to be able to trade things in every single market. So when Summer was asking about my spreadsheet, I basically have a quite detailed spreadsheet that has all of the delta variation on all the different types of trades that I play. And they all correspond to different times in the market. So right now, with the VIX where it is, if we look at where the VIX is, it's clearly above its lower averages, which I said before is around 17. Oops, sorry. Try it, wrong button there. 17, 18. This is kind of the typical. If lots of people ask, where is that level? It's right around here. That's kind of the normal VIX level. So we have been in elevated VIX all of this year, which means that it's a really great time to sell iron condors in general. And it's an extremely easy play to set up. So this year, that's what I've been doing. And my delta neutrality comes with the fact that those condors are an easy setup, and my expectation is that the stock market is not going to rally very hard nor drop much further. And by having a delta neutral portfolio, we constantly get paid theta decay, and we can kind of adjust over time. Now, closing early helps with the smoothed out returns. So you'll typically see me put on trades that are 45 days. When the VIX is this high, I usually do it around 38 days. I take that extra week off there. Then I'm closing around the 15-day to expiration mark. But on SPY, a lot of my trades super boring. They're just like 38-day iron condor, take them off at 15 days, put a new one on, rinse and repeat. And the idea is that with that, you get a pretty consistent return over time. The idea, of course, is to make money. So we're trying to do that with a combination of different strategies. And I have a huge toolbox of different things. I have no problem playing diagonals, double calendars. And I try to put on such a large variety so that people that join my group can actually talk about that and see, different things that come up. So when we're doing different strategies, then I'm there to ask questions or answer questions rather, and say, hey, this is why I'm doing this. This is what my assumption is. Because as a full-time trader now, I retired almost 3 years ago. Can't believe it's been that long. It's kind of crazy. So this is the money that I make off my options income is the money that I live off of, and it's pretty great to be able to do that. So let's get back over to some other questions. So Richard's asking, sold a short put in IBM today at strike 124, collected 266, expiration 826. Does the risk return here make sense in your opinion? Richard, I can't remember if you're a patron or not. I know you join these live streams a ton. I did mention I don't like IBM. IBM is not, it's profitable, which is good. Profitable is a good company. I just don't think they're in that position where they're putting out a ton of new innovative products that are going to allow the stock price to go up. So not my favorite company. Short puts, so when I look at this, just to confirm here, you sold the short put on IBM today, strike price 124, collected 266, expiration August 26. Does the risk return here make sense in your opinion? IBM obviously got absolutely hammered on earnings, down 6% today. If we look at the Bollinger Bands on IBM, you will see that it is trading way outside of its normal, not IGM. Let me learn how to type here for a second. IBM, if we zoom in here and take a look at what this move is, stock's trading down here 120, 129 right now, but way outside the expected move, and that was because of earnings. So what obviously selling a put in a day like today is great, and that strategy is an entirely sound strategy. Typically, when I'm picking my deltas for new positions, I'm looking for at least 30 days out, somewhere between 30 and 60 days, slightly shorter durations in high VIX. This is obviously high VIX, so this 38-day strike selection I think is bang on. Now, you can sell them however tight you want. I typically don't sell under 16. So in this case, there is no 16. We've got a 12 delta and 21 delta. So somewhere between the 115 is the low put that I would sell, and the highest put that I might sell would actually be, I have no problem going in the money, because selling an in the money put is the same as selling a covered call. So buying stock and selling shares. Lots of people just do at the money, but depending on how bullish or bearish I am on a particular stock, I would consider even selling something up here. So from a risk to reward standpoint, making 1% a month on puts is an extremely lucrative return in my opinion. So selling the 120 fetches 145, which the stock is trading right now at 129. So $145 is more than 1% right around 38 days. That would be, is it lucrative enough? Yes. Anything below, or sorry, above the 120, lucrative enough. Collecting this 115, you're only making 80 bucks, not lucrative enough. So which positions are lucrative enough? If that's the question, any of these. Really depends on trader assumption. If I was super bullish and I thought that this stock was going to be back up over 135, down $8 today. So if I would have no problem whatsoever selling this put, collecting $800 today. I don't have to buy the shares. Margin impact is $6,000. And if we look at the profit profile, basically in order for it to make money, the stock has to trade above 136, has a 55% probability of profit, which is greater than buying the shares outright, which obviously have a 50% probability of profit. The break-even is 127, which is $3 lower than it currently is. And that would be a pretty easy trade for me to take on if I was extremely bullish. Now, if I was somewhat bullish and I thought the stock was going to rally a little bit, I might sell the Atem Money, the put. There's more extrinsic value in it. This put is only is slightly out of the money and has $400 in extrinsic value. So from a extrinsic value point of view, selling close to Atem Money is obviously optimal. The trade makes $400, uses almost as much margin, a little bit less. And obviously the agreement is for $600 less than my previous example, because I would be agreeing to buy the stocks for 129, getting paid $400. The break even's lower, 124.94, which means the stock would have to drop $5 before I actually start to lose money on this trade. And again, I could just go down. I can say, is this worth it? Absolutely. $266 on a $12,000 position. I mean, the max loss on this is $12,000 if IBM went to zero, which I'm not expecting it to do, and getting paid $266 if that's what you collected. Was the 120? Talking now, too many things. Yeah, 124. That's the 124. I think this is totally worth it. Now, I would be, if there was a rally, I mean, obviously this is a bullish play. If there was a rally, I would absolutely be turning this into a strangle as soon as the stock came back up. So as the stock moves up, these calls will increase in value, and I would try to find the place that and sell a call if I can get a decent credit for it. Probably wouldn't enter it today if I was bullish on this position. The other thing you could do is do a put ratio spread, and get almost or similar money. Let me just look if there's a decent setup. It's probably not. But if you did the 124, sold 2 of those, and then bought the 124. So now don't get nearly as much money. This is only about $50. But you have the potential profit spike if it goes down. The break even is extremely low. Now I have way less risk. The max loss is almost $1,000 less. It requires slightly less margin. And obviously it does require a down move in order for this to happen. The other thing I could do is do like a little fancy, a 3-to-1 put ratio spread, which is really nice. And then just using some of that extra credit to buy a long call at a lower value. And what you end up with is a similar break, even slightly higher in this case, 117. The credit to open is much larger. So now I'm getting $121 on $120 stock, so nearly 1%. And I have the potential, if it does drop down, to make another $400, because this spread this is a bear put spread that's embedded in this. So this portion of the trade would make $4. And if it was tested badly, then I would be able to roll this out as a naked put if the stock was to drop down. But this trade has a much higher probability of profit, collecting a little bit less money, but still really in the realm of that 1% per month, giving a way lower break even down at 117 and the potential of making, you know, another $400 if the stock was to drop down. So I like this kind of setup. And this is what I was saying about like being creative in and not just selling puts and saying, well, there's always a potential on these trades. And it's good to understand a trade like this. One of the things I love about this, like today, two of my trades on Disney and Caterpillar, I was able to convert to free butterflies, because to convert this to a butterfly, all you have to do is buy back one of these positions. So if I was to collect this 126 today, and then the stock did rally up, all I have to do is buy back one. And as long as I pay less than 126, which is my opening credit, then I basically have a net credit on a trade, and the profit profile would be, in this case, it wouldn't quite be a free butterfly because you'd need the 125, 120. But you would end up with a butterfly like this with no potential loss because it was a net credit. And the way that would function is it would get entered as a 3-1-1 butterfly. It's not really a butterfly, it's 3-1-1 ratio spread. Say that wrong again. It's a 3-to-1 ratio spread. So I'm selling 3, buying 1 of the 125s, which are higher puts than the short puts. And so I have 1 bear put spread in here, and then buying a protective put on 1 of the extra, so that I'm still only allotted to 100 shares. You can see the max loss is 11,975, and that break even is 117. So I'm on the hook for $12,000 if I had to buy shares, but with this nice potential, getting a decent credit to open, using that credit at a later date to buy back one of these puts to create that butterfly. That's a mouthful, but these are the type of trades that I'm loving to do right now. No upside risk, and if the stock rallies, then I can do a call butterfly, and you know, there's no reason not to do that. You could do it right off the top. You could do the exact same thing. You could say, well, I'm going to use, you know, I'm going to sell 3 of these. And your credit you're collecting obviously has to be enough to cover the purchase of the other portions. We could do this little guy here, 143. And so now the net credit on that is the 130, and we've got kind of a modified Batman. And we went over earlier in this video, but it's a net credit to open. So as long as the stock stays above the low long call, which is 137, and above the high long put, which is 125, then all the options will expire worthless. So if it stays between 125, 137, then everything expires worthless, and whatever you've collected today, 127, becomes the realized profit on the trade. This one has double risk, but you're getting a little bit better credit to open. Well, actually about the same, 127. So you're getting this little extra profit spike and adding some upside risk. But if you thought the stock might rally, and this is usually my assumption, it's like, which way is the market going to go? I never know in this case. I mean, anybody that tells you that they know is completely lying, because how does anybody know? If it was that easy, it'd be easy. But putting on trades that make a bit of money if it goes one way or the other are quite nice and quite easy to do in this particular market. All right, so let me look. Todd's asking, I own CPNG shares at $25 and short the November 1750 calls. How would you play this? Well, okay, so the first thing I want to say about any questions with this regard is that I don't know, I don't follow CMPG or CPNG. I don't know what the stock price is, but it has, cost basis has no bearing whatsoever on what decisions I make today. I own Amazon shares that I bought for $400. I mean, Amazon's now split since then, but Amazon shares that I bought years ago, and they're worth way more. And I don't make decisions based on my cost basis at $400. That would make no sense whatsoever. I only make decisions on what the price is today. So with that caveat, let me look up CPNG. I'm not trying to be like aggressive or rude or anything. I'm just, it's one of those things that all of these questions come up, and I'm always like, well, Okay, like who cares if the cost basis is 25 bucks? The stocks were 1770. Like that's what it's worth. So if I had 100 shares, it's currently worth 1779. That's what I make my decisions on. So short the November 1750 calls. November 1750 calls are way out in time. You probably did that because you were trying to get a huge amount of credit for it, but there's like zero theta decay. Like even in the IBKR software, it doesn't even like to go out that far as its default setting. When we're trading something that has more than 60 days, there's very little theta decay in general. So almost all of this value, if we're looking at it, is the theta decay is super small. When I want to make money off of shares in theta decay, I trade shorter duration than 122 days. It's pretty easy once you do this a while. Like I kind of gave that overview earlier of like the timeline. And when I started trading, I was trading on 30-day interval all the time, and it was pretty quick for me to understand. It took 6 months, under a year. It took for me to understand that there was slightly better premium if I went just a little bit longer on most of the trades that I was doing. So I was able to naturally find that sweet spot just by trading with frequency and just paying attention to what I was doing. How much money did I make on a 30-day? How much money did I make on a 35-day, on a 40-day, on a 60-day? And then, go check out Tasty Trade. I mean, they've done tons of studies on this. And all we have to do now that I know what I'm talking about, after a few years of trading options, it's really about theta decay. That's how much I'm getting paid per day to hold that position. So in this case, what I would be looking at if I was trying to trade infrequently and I was looking at this strike, I would be looking at selling the 1750, which is at the money, and look at this theta decay. It's double. The November's losing time value at $1.20 a day, and the time value on the August 19th is 1750, and that would not be a bad position for me to be in. I mean, I'm trying to make back money, and in this case, I'm getting paid, 2 cents a day for every day that I hold this. And depending on how much cost there is to roll, and whether or not there's extrinsic value, it depends on the stock. So in this case, if I was holding a 1750 and I was forced to buy it back because I didn't want to sell my shares for 1750 and I just wanted to extend duration, am I getting paid? Let me clear this all off for a second. I would have to, I know you have the November, but say I had the July 22nd and it was coming up and I've got the 1750, there's still 30 cents in value, extrinsic value. This call is in the money. I wouldn't be rolling it yet. I would be waiting these couple of days and hoping that it stays at that 1750 or above. I mean, this is perfect. This is where I want the trade to be. And then, because if it can stay at the money, then I'm going to get paid to buy it back and roll it out. Even today, I'm getting 30 cents. So I would be reducing my cost basis or giving myself $30 in cash to purchase whatever I wanted. So if I was long CPNG and I did this roll and I was concerned that I was going to lose my shares and the stock was going to go back up to $25, what I would do is I would use this credit to buy more shares. So as I said, I wouldn't do it today. I would wait till that extrinsic value is a little lower on a stock of this price, $17. I would wait till it was under 10 cents. So in this case, there's still 38 cents. I would wait till there was under 10. And as soon as it was under 10 cents, then I would roll it out, knowing that I'm going to get a decent amount of credit. And I would take this, $50 that I would get if I waited. I'd probably get around $50 credit, and I would buy 3 more shares. So now I have 100 shares at that I'm trying to sell for $17.50, and I have 3 shares that have unlimited upside potential. And then the next week, I would hope that the stock was again around that $17.50 mark, and I would do it again, and I would continue to roll. And I would, rather than chase it up, I would just, as long as there was extrinsic value every week, I would take that extrinsic value and I would buy more shares if I was bullish from those levels. as I do that, especially if it goes up again, then I would, it would be constantly paying me cash and I would be expanding my position, which means I'm expanding my downside risk, which may or may not be the place to be. But having an in the money call actually reduces our downside risk a little bit because the stock can drop and the call is making some money and making some money. So I don't mind rolling in the money calls, and they are for cash flow. And if the stock did rally up to 25 bucks, then oh well, that it doesn't matter. You got 1,750 bucks back. At least you're not losing more. So I'm not married to any shares that I have, and if they get called away, whoop-de-doo, they get called away. I mean, this week I'm going to lose some AAL shares. Long term, I'm bullish on American Airlines, but the trade doesn't make sense to roll, so I'm not going to. I just get the cash back, and I'm going to put that cash into a new trade that makes more sense of making money. That's the goal, is to protect our downside risk and do not ever complain about a winning trade. But in this type of thing, that's 1750. I would be holding the August positions, not November, but that would just be for Theta Decay. That's my thoughts on it. Vladin's asking about Verizon. It's already 12:06. We're already an hour in, so I will probably So Kish is also asking, can you walk through how you trade and defend your covered call positions where you sell 2 calls against your single position? Yes, I will. So in this case, I'll just do it because I have this example up. Let's just say that I was in this position and the stock had rallied up and I was going to lose my shares at 1750 and I was forced to buy out, but I'm looking at the chart and saying, I don't think this is going to go up all that much. It's going to go up somewhat. CPNG, I don't trade this. Oh, that's a bad looking chart, isn't it? Not saying that it's destined for failure, but it's had quite the sell-off. Oh, and this is new. I don't know what the stock is at all, but okay. So we're only trading back from last March, and it's been trading down the whole time, which, obviously this must be tech sector or something. And the cost basis, I know Todd was talking about it. You bought in here $25. So it's not like you were buying at the top, which is great. But in this position, when I see a stock that is pushing up at the top of the Bollinger Band above its recent moving average, my expectation on these is that they are going to come back down. I'm not saying they're going to come back down this far, but they're probably going to come back at least to the moving average. And this moving average may continue up from here. So we may see the stock, do something like this over time. But this will stay within the Bollinger Band. The Bollinger Band, if it continues, will continue to expand. It could look something like that. Now, don't hold me to that prediction, but that's the kind of thing that could happen. That's where the stock could go. And likewise, it could go down. So we never know what they are going to look like. But if it continued to trade down, the Bollinger is going to go like this. And this line is going to smooth out, and this is the moving average. It's going to continue down like that. And in which case, that would happen if this stock went down and then up and traded in that range. If the stock traded like that, the Bollinger would look like this. So at this point in time, when we're looking at this and we're saying, wow, it's already at the top of its recent range, we are seeing a pretty aggressive move, but I think it's going to pull back a little bit. And I would be considering that. I would be looking at this chart thinking it's probably going to pull back a little bit unless they've really turned around something in their company. So let's take a look at how I would defend this position with the forward thinking that the stock is going to pull back a little bit. So obviously coming up in July, I'm going to have to roll this out. And as I roll it out, what I might do is I might sell the 1750, but then I might sell an additional position that's out of the money, 1950. And the reason that I do that is because it gives me extra credit. This first portion gives me 30 cents for the roll. So I'm buying back for 70 cents, and then I'm selling the new 1750 call at almost $1. And then I'm selling a second one for another 27 cents. Well, if you look at what this is worth, right now I'm paying 69 cents or 70 cents to buy this out this week. So my assumption is if the stock doesn't move, that I'm getting $1 today and I'm going to have to pay 70 cents again for this position to get closed out. As I do that, I am also have made another 25 cents on here. So I have $25 more and then $30 from this one. So I've doubled the potential. Now, one of the things that this is doing is it's creating upside risk. So if you were to look at this position in total and what it would look like, it would have downside risk. So if we own the stock, we look at the profit profile, it looks like a strangle. And that 1950 is adding upside risk. So I wouldn't want to do this if the stock was massively going up or my assumption changed and I thought it was going to go up. It would be better for me to just roll this as a covered call and then wait until it was at a high enough level that I got to that point and said, okay, now it's finally there. Now is when I think it's going to go down. And that's when you sell the call, the second call. So that's kind of how I defend the covered call positions where I sell a second call against my single position. And I do this pretty frequently. This is a typical thing because this reduces my downside risk by 25 cents. In this case, doing this trade 25 cents for a week, which is pretty amazing. This is giving me a cost basis reduction of 25 cents because it's giving me 25 cents more credit. And I can then again buy more shares. So in this case, if I sold both of them, I would be able to, instead of buying 3 shares as my previous example, I would now be getting, I'd still be buying this out. So on that roll, I would be getting 60 cents and I can buy 4 shares instead of 3. So now I have 104 shares. So it's creating bullish. This profit profile obviously doesn't function because it's not including the long shares that I would have to hold to be in the position that Todd was mentioning. So hopefully that answers your question, Kish, about defending your covered call. And then Vladin's asking about a Verizon Iron Butterfly into earnings. Any thoughts? Okay, so let's go through this just super quick. So the first thing we're going to do is look at Verizon on Seeking Alpha. It's kind of my first step. Profitable, which is great. Poor growth. Okay valuation. The P&E is 9. This is not terrible, but it's not great. I mean, this isn't a tech stock. This is a utility, basically. It's a telecommunications. So I would not be, this wouldn't be a buy for me, just based on that P&E ratio. I'd want it to be a little bit lower, but I would want to take a look at the price action. And so we now know what those numbers are. You can see why I use Seeking Alpha. And again, if you guys are joining now, I see there's quite a few more people on. I do have a link down below for Seeking Alpha, which gives you a 50% discount, which is pretty awesome. And it's a pretty awesome affiliate program for them to offer that to us and to you. So appreciate that. If you guys use that link, it gives me a little kickback. So thank you. And Verizon, where are we trading right now? 50.32. Here's those Bollinger Bands, which are just collapsing in. Now this company is profitable, so this is crazy when you see this kind of stuff. Like this must have been the last earnings. Just need to scroll over here a little bit. The last earnings, and wow, they just got pummeled. Are we expecting that again? Probably not. The stock has already recovered back. I would be looking at this long-term average here and saying, where, if that continues, what does the stock price have to do to get that to happen? And the stock price is going to do something like that. So it's slightly bearish in a company like this. So iron butterflies, I don't love iron butterflies personally, but I will collapse into an iron butterfly if I'm tested, but not particularly my most favorite trade in the world. So looking at the Bollinger, we're looking at 51.85. Earnings are July 22nd, so that'll be before the bell, and we've got this 49.95. So basically, from $50 to $52 is the Bollinger Band. And now let's take a look at the next portion, which is the potential expected move. So we just look at the option chain for that. We'll look at Verizon and say, okay, July 22nd, we look at the money. What's the cost to buy? Pretty simple, 85 bucks. Add that to the long call, to the long put rather. You can see it's $134. We do some quick math, times that by 90 cents or 90% rather. We're looking about $1.10 move. The stock's trading at 50.37, so $1.10 above would be 51.50, and $1.10 below would be 49 and 25 cents. Boy, my brain's going here. I'm gonna have to wrap this up pretty quickly. And so looking at a butterfly on that, what do? You expect the stock to really not move at all, so do like a wide butterfly like that maybe, and then I don't like to be so neutral on these. This cost 80 cents to open, and the potential of making $2 if the stock's right at 50 bucks. I mean, all you have to do is look at the profit profile, and 40%, 47% probability of profit. I don't love that trade. Could you tighten it up and just make it a lot cheaper? Sure, but then the potential is lower. Now you're risking 20 cents but again, your profit profile is super narrow. You're looking at a, $1 range, basically, just over that, $1, almost $1.50, but pretty tight. And again, why I don't love butterflies in general. I would be much more inclined to say, okay, let's do a $1 wide on a stock that's only $50. Do the $1 wide condor and say, okay, well, this is similar. I don't love Verizon. This is where you get these trades. Sometimes you're like, yeah, this is super great. This trade only has $40 max profit, 52% probability of profit. That's based on getting 39 cents. The spreads are pretty tight in here because there's lots of volume. So it should be easy to trade. I don't really think this is a great trade, but that would be the setup that I would do rather than a butterfly. And then on Thursday night, if I entered this today, I could collapse it down into a butterfly because I could move one side tighter if it did move. So if it went to the downside, I could move it and hopefully, tighten it up over this 3-day trade. The other thing to do is just look at it out and in one week further out, which would be typical for me. But I know when people are playing butterflies, they're usually trying to pin it right on a really short duration. And that's why I trade unicorns, because they are a little bit easier to handle because they have profit spikes that are similar to a butterfly, but you're just not paying that massive extrinsic value of the long protective put and the long protective call in this case. And you're just getting so much value sucked out. But this I think would be a slightly better trade if I was neutral on. This has got just slightly negative delta on Verizon, which is probably how I would set it up personally, looking at that chart. But that's kind of the way to go. And look, the probability of profit is 39%. And so overall, I think this is a no-go trade for me. So that one is not for the books. Kish says, thanks. I hope that made sense. So that looks like it's it. Remember, guys, to hit that thumbs up button. It helps me a ton. If you have any specific questions that you want answered or you want me to do a video on, please let me know in the comments. Appreciate all the support. And let's, as always, get rich together. Thank you so much. See you very soon. Take care.